Okay, we're now going to look at the preparation of a multiple step income statement. This is, of course, for a merchandising business, and the name of our company here is Castle Company. And we're given their adjusted trial balance. We have sales revenue, of course, revenue account, sales returns and allowances, and sales discounts, both contra revenue accounts, meaning they'll reduce the balance of sales revenue on the face of the income statement to come to net sales. A new expense account in this unit, cost of goods sold. Now it's a little odd in that it doesn't have the word expense in the title, but it does have the word cost, and it is considered an expense account. We'll deduct that from net sales to get gross profit. Another expense account that doesn't have the word expense in the title is freight out. That's going to be an expense incurred if we sell merchandise and deliver it to the customer, sometimes called delivery expense. And then we have advertising expense, interest expense, salaries and wages expense, utilities expense, depreciation expense, and interest revenue. Of course, it's a revenue account like sales revenue, but it'll have to be shown separately at the bottom of the income statement in the other revenue, other expense section. So let's get started here. We'll head it up with Castle Company, the name of the business here. You know this already, I'm sure, but on the next row we'll put income statement. And then the income statement is prepared for a specific period of time. So it's dated as such for the year ended December 31, and then we, of course, insert whatever year. All right, and then on the income statement, as you know, we would first list revenues or revenues earned through the principal activity of the business. In this case, they're a merchandising business and they earn revenue by making sales. So we'll list sales revenue first. It's over in the right-hand column, but please don't think of the right hand as a credit column on financial statements. It's just a way to present the numbers. So we'll kind of put totals over in the right-hand column and a group of numbers to sum or take the difference in the left-hand column. From sales revenue, we will deduct sales returns and allowances and sales discounts, our two contra revenue accounts. We'll list those both here in the left-hand column. Then we'll total the two, comes to $20,000. And we'll move it over to the right-hand column. Now we're going to deduct that from sales revenue to get to net sales. Okay, from net sales, we will deduct cost of goods sold, and that'll give us our gross profit. You guys, that part of the income statement is probably, the most different of any of the financial statements we look at here for a merchandising business. For a service business, we just listed service revenue and then deducted expenses. But for a merchandising or even a manufacturing business, we'd start with sales revenue and work our way down to gross profit. Now from gross profit, we're going to deduct operating expenses. And our operating expenses would be, sorry for the ding there, my phone should have been on silent. Anyway, from our operating expenses would include all of these. Okay, so we first list freight out at $2,000. Advertising expense at $15,000. Now you don't have to put expense here because what we've shown above that this category is only includes expenses. Then Interest expense and interest revenue would have to be shown separately at the bottom in the section I mentioned earlier, other revenue and expense. So we'll skip over that one for now. We have salaries and wages expense, utilities expense, and depreciation expense. Now we're going to total these and list total operating expenses over in the right-hand column. And that has to be deducted from gross profit to come to our next amount, operating income. And you can kind of think of gross profit as really your markup. How much did we sell the inventory for above what we paid for it? And then out of that markup or gross profit, we have to deduct our operating expenses. So we come to operating income of $83,000 in this case. Then we have the section other revenues and expenses. Now there we would list revenues earned from sources other than the principal activity of the business. Castle Company looks like their principal activity is buying and selling inventory. They're a merchandising business. They're not in the business of loaning money, so interest revenue for them would not be their principal activity, so it would be shown separately here at the bottom. And then interest expense, which was $18,000, will also group here. I think that's just to draw attention to it so it's not lumped in with other expenses. Now we'll take the difference in those two, which of course is $12,000. And revenue was more than expense, so total other revenues and expenses net to $12,000. And since revenue was more than expense, we will add that to operating income. Had expense here been more than revenue, or maybe we only had expense here, then of course it would be deducted from operating income. And then that gives us, all the way down here on the other page, our net income, $95,000, just the 83 plus the 12. Okay, thanks a lot, you guys, and as always, please reach out if you have questions. Thanks.